저는 한국기업협회 국제무역연구원장 황호수입니다. 이른 아침 세계무역 포럼에 일찍 참여해 주셔서 대단한 것 같습니다. 먼저 제 것으로 말씀을 드립니다. 오늘 강의는 원래 세계경제연구원의 서울 이사장님께서 진행을 맡아주시기로 되어 있었으나 잘 아시다시피 서울 이사장님께서 오늘 아침에 대통령실 인수위원회에 참석하시는 관계로 오늘 참석을 못하시고 있습니다. 그래서 이번 행사에 공동으로 주최하는 무역협회를 대신해서 제가 진행을 맡기겠습니다. 이건 너무 양해 말씀을 먼저 드립니다. 저희가 왔듯이 영어로 진행을 하겠습니다. 동시 토론가 준비되어 있으니까 사용하시기 바랍니다. Good morning, ladies and gentlemen. My name is also Hyun. I'm a president for Institute for International Trade in KITA, Korea International Trade Association. KITA is the co-organizer of this forum with Institute for Global Economics. It is my great honor for me to moderate this forum in place of Dr. Sabong. First of all, I would like to ask for your kind understanding that Dr. Sabong was unable to be with us today due to his responsibilities as a member of Presidential Transition Committee. Dr. Sabong asked me to convey his apologies and best wishes for happy and prosperous union. As you know, it's become a tradition to open the World Trade Forum with a session on economic outlook of the new year. As the year meltdown in the United States, oil price hike is another risk that the global economy faces. Within Korea, however, there are high expectations of an economic revival with the launch of new government. All in all, it's the most appropriate time to accept the risk that lie ahead of us in the year of change. 2008 begins, the world economy is going into a recession, most apparently shown in the advanced countries such as the United States. The global financial market is still reeling from the shock of the subprime. It is said that economic forecast and weather forecast have many similarities. Both economic forecasters and economic forecasters develop forecasting models, but are quite often blamed for wrong forecasts. However, there is one advantage that weather forecasts have over economic forecasts. At least everyone agrees on what the current weather is. On the other hand, it is difficult for economists to agree on where the current economic situation stands. In this sense, we are very fortunate to have Dr. Sinai in the first World Trade Forum this year. I'm very sure Dr. Sinai gives us a special wisdom on the world economy now and in the future. I have a long list of Dr. Sinai's prestigious career. Dr. Alan Sinai is a chief global economist, strategist, and president of Decision Economics, a global economics, strategy, financial market information support, and advisory firm. During his career, Dr. Sinai has served a wide variety of organizations and decision makers in the United States and abroad as a forecaster, educator, and econometric model builder. He has been consulted by various administrations from both political parties on key economic and policy issues. He has often testified before Congress and is regularly with senior level policymakers from other countries. He is a recognized expert on Federal Reserve and monetary policies, both as a scholar and in forecasting Federal Reserve policies. But I would like to introduce that Dr. Sinai is a great economic forecaster without his permission. He won 3 Forecast of the Month awards for the most accurate predictions. He was the top forecaster in the USA Today surveys and the Wall Street Journal survey in the year 2006. Dr. Sinai has visited Korea several times in the past to give lectures and keynote speeches and so on. Last year, he has emphasized the seismic shifts, referring to major shifts in the United States and the global economy. Today, Dr. Sinai will speak on the U.S. risk to Asia and global expansion. Without further ado, let me invite Dr. Sinai to here. Please give me a big applause.
Thank you, Dr. Chen, and I want to thank all of you, many of you here for the second year in a row and maybe before, and that is a great compliment to me to see so many familiar faces who come once a year for a few perceptions from this humble economist from the United States. The global economy is alive and well, now into the 6th year of one of the most robust and extended world economic expansions ever. Led by the United States, the developing world, that is emerging Asia, emerging Latin America, and emerging Europe, commodity producing country exporters, a recovery in Japan and in the Eurozone. The global economy has turned in 5 years of sustained growth in the 3% to 4% range, and is likely to do so again in 2008. For this year, the 45 countries that we cover and forecast, about 93% of global output, that we are projecting global economic growth at a little over 3% for real GDP. This follows almost 3.5% in 2007 and an actual 3.75% in 2006. The expectation for the global economy is weaker, for a weaker prospect than previously, but it's still a solid and positive prospect. By comparison, the global economy, as we define it, grew only an average of 2.75% per year from 2000 to 2005. The global economic expansion really picked up steam in 2003, along with the U.S. economy, moving up in growth to 3.5%, 4% from an anemic just 1.75% in 2001-2002. A very sharp upturn in growth for the whole global economy occurred from 2003 to 2006, continued in 2007, will continue in 2008, we think, but at a slower pace. So far as we can tell, of the major countries and global regions in the world economy, only the United States appears to be in the late stages of its economic expansion, sliding now into what looks like at least a recession-like situation, perhaps something worse. That is to say, low positive growth in real GDP, but with many recession characteristics. A housing downturn, probably a bust in housing. Rapidly falling home prices, deteriorating consumer finances, tight credit, weakening consumer spending, declining growth in business sales and a profits recession, rising unemployment and less job growth, worsening consumer sentiment, and disappointments for a lot of businesses in their expectations, which will bring cutbacks in production and employment and in capital expenditures. Then higher unemployment, less generation of income, less spending. What we economists call a self-reinforcing, cumulative, and spreading process that, even if technically not defined as a recession, feels like one. Recession-like. Flu-like. Feels like it, but you can't technically call it because of the way we define the animal that's called recession. We think we're there now in a recession-like situation. Fairly early stages of it. And there is a risk that the U.S. economy could go down even more as we move through 2008 and into 2009. One reason is excesses and imbalances of boom and bust, a housing and credit boom and bubble, and now the unwinding of these excesses. That's one reason for the risk assessment of the U.S. situation. A second is rising inflation for crude oil, energy, food, healthcare, and lately import prices because of a lower dollar. The rising inflation is curtailing purchasing power, hurting business sales, raising business costs, and hurting profits. A third reason is a negative credit shock, an effect of the housing downturn, falling home prices, and the declining value of housing as asset collateral. The subprime mess that resulted in credit crunch that's causing a contraction of credit within the U.S. financial system, the extending of finance from one financial institution to another, or let's say the lack thereof, and is causing shrinking balance sheets for the huge non-bank financial intermediary institutions sector that provided so much fuel for the U.S. and global expansion of recent years. Those, by the way, are the private equity firms, venture capital firms, leveraged buyout firms, investment banking brokerage companies, hedge funds, a huge number of, and with unmeasured magnitudes of credit extension, debt finance, levered by balance sheets, that added much to the global and U.S. expansion of the past few years. That force is operating in reverse now. It's a significant risk. What is of most concern is our inability to know how much of this is out there and what the fallout effects are going to be as the balance sheets of these financial institutions contract. A fourth reason is the inability of the Federal Reserve to aggressively ease monetary policy enough to floor and arrest the downturn, mainly because of a simultaneous rise of inflation that is preventing the Federal Reserve objective of price stability and low inflation from being satisfied. This is a kind of stagflation, relatively mild compared to the late 1970s and early 1980s, but stagflation nevertheless that currently is characterized in the United States. Subpar growth, rising unemployment, and rising inflation, all at the same time, with inflation above current Federal Reserve upper bounds of tolerance. A fifth reason is the underlying long-run context of global imbalances, mainly on trade, the current account, private sector saving and borrowing, and most of what I've said in the U.S. and also in central government budgets. The long-run global imbalance concern, I'm afraid, at least for the United States, is coming home to roost in market forces that are going to force American consumers and businesses to cut back, to save more, to reduce debt, to shrink balance sheets, a lower dollar, all part of natural market forces that will enforce discipline in markets and in economies if policymakers don't take appropriate action. And in the United States, I think we all know this, and certainly in Asia, in the case of the imbalances that exist in China, in part because of a very inflexible exchange rate, those imbalances over time can set up market forces which in turn act to force the private sector to rebalance the imbalances. But unfortunately, when this happens, it can be painful. In the U.S., the declining stock market, declining dollar are part of that process. And the very distinct slowdown in the growth of consumption compared to trend. It's a very pronounced new trend in aggregate consumption in the United States. Below trend growth in spending by the American consumer. That is something that's important for the Asian area to pay attention to, because American consumers buy a lot of goods from Asia. And I can tell you, fundamentals surrounding the American consumer are virtually all negative now. And the numbers tell us that we have a downtrend in aggregate spending by consumers. 2.9%, not a bad number, 2.9%, 2007, 3.1%, 2006, 3.2%, 2005, against historical trend, an historical trend of 3.5% a year for 45 years. Consumer spending now has been slipping below its historical trend systematically for the past 3 years. Our expectation for growth in consumer spending this year is somewhere around 2%. That compares with 3.5% trend growth. It's positive. And because consumer spending is 71% in real terms of GDP, it's hard to get a negative GDP if 71% of spending goes up by 2%. But if you are in business, or if you're a country where you are hoping for and expecting American consumers to buy a lot of what you produce and sell, aggregate spending of 2% against the historical trend, which has probably conditioned your expectations, is a very bad year. Percentage point and a half shortfall. This one is tough. Forecasting could be as high as 2.5%, could be as low as 1.5%. In the United States, aggregate consumer spending almost never goes negative. Almost 60% of our spending is on services that provides a profit. 16% of consumer spending now is on healthcare. And healthcare will not go down. Healthcare is a booming sector and industry in the United States. So we have a built-in prop to consumption up to a point into real GDP. Hence, it's one of the reasons why we talk about the U.S. economy and try to get away from the technical definition of recession. It's hard to have that happen. Recession-like, I think, conveys the message. We may not have a technical recession, but for business and for markets in the United States, it is behaving as if we were already in one. Well, without conscious, coordinated macroeconomic policies to rebalance the imbalances which exist in the U.S., China, Japan, and the oil-producing nations, the forces of the economy and markets can enforce such a rebalancing, unfortunately, painfully so. And for the U.S., we think we're going to go through a painful period of adjustment over the next year or so. For the non-U.S. economic world, the downturn in the U.S. economy is the major downside risk or negative external shock that could spoil what otherwise is a healthy-looking global expansion that should have a good deal of time to go. Other risks for the global economy include the negative effects of higher oil prices for oil-producing countries and energy inflation, food inflation as well. It includes central banks in some parts of the world raising rates, such as China, or that are hamstrung, such as the European Central Bank, unable to reduce interest rates on a weakening economy because inflation is too high. And for the United States, a problem. It isn't that the Federal Reserve can't or won't reduce interest rates. The Federal Reserve will do that. But the amount of interest rate reduction that is necessary to stop the economy from its downward momentum is very hard for the Federal Reserve to do if at the same time inflation is higher than the goal of price stability will allow. And then we have the financial market effects of the U.S. downturn, a bear U.S. equity market. We have declared some 4 or 5 months ago the U.S. equity market to be in a bear configuration. And we think it's a bear market, and there could be some other stock markets in the global economy that will turn bearish as well. The effects of that, and finally, whatever excesses and fragilities might crop up in countries outside of the United States, inner problems, financial problems, excesses and imbalances in real estate, that was a concern here in South Korea for a while, that cannot be seen now. In Washington, the policies that are likely to be applied to stem the downturn, to preempt the U.S. downturn, at least the downturn in growth and maybe in the level of activity, do not seem to us to be coordinated enough, nor able to deal quickly, nor are they the ones that are being talked about in a big enough size to necessarily prevent a worst-case scenario from emerging in the United States. The worst-case scenario would be a full-fledged, well-defined recession, as opposed to a recession-like world. For the GDP aficionados, let me define the terms. Recession-like corresponds to GDP growth somewhere in the ones over the next year or so. Recession-like would not necessarily give us a string of negative monthly indicators, for example, non-farm payroll jobs. That is what the National Bureau of Economic Research uses to define a recession. By the way, 2 negative quarters of real GDP is not the definition of recession. It's the popular definition. It's the media definition. The technical definition of recession in the United States, the National Bureau of Economic Research, is for a wide range of monthly economic indicators across a lot of activities to show a lengthy string of negatives in the level of economic activity. It goes down in absolute terms. The key one is non-farm payroll employment. Non-farm payroll employment has not produced a negative yet. We had 1 negative, and on revision, the data, it went away. The National Bureau will not be able to declare a recession, technically, unless we get a string of negatives for non-farm payroll employment. Well, in that particular indicator, there is something called healthcare. Healthcare is an ever-increasing part of the U.S. economy. Every month, healthcare grinds out 30,000, 40,000 jobs a month. I don't think there's anyone in the United States that thinks healthcare is going to have a recession. It's a booming sector and industry. People like me need a lot of help. Doctors, nurses, wheelchair providers. We are buyers of the technology, heavy consumers of medical care, and there is a third-party payer. We don't think about what we pay. The costs get passed on through the society. It's a booming sector. So one question we ask is, if we are going to grind out 25, 30, 40,000 jobs a month in non-farm payroll just out of healthcare alone, can we ever get a negative so that we could technically define a recession? we might not be able to do so. So technically, we'll never have a recession, but we have a bare equity market. We have all those things I said: consumer sentiment, business profits declining, recession-like. Recession would be a string of negatives in monthly indicators like non-farm payroll, industrial production, business sales, personal income less transfers, all of the ISM survey numbers. That the leading coincident indicators would go down. That would be a clear-cut recession, and it would be associated with declines. It wouldn't have to be big declines in real GDP for a year or at least 3 or 4 quarters. Recession-like GDP growth in the ones, slowdown, 2 to 2.5% GDP growth, and then there is something that is not on our radar screen, which would be a revival back to 3% growth or so on average anytime in the foreseeable future. Well, for the global economy, and let me turn to a quick scan of the global economy for you. Here's what we see. In most global regions, relatively stronger growth in the United States is very likely in 2008. In Asia, we are expecting strong dynamic growth, continuing the pattern of recent years, although with some slowing in China, India, Japan, Singapore, and South Korea. Just a little bit of slowdown in South Korea, and that's because the new president's not in office yet, and those stimulative policies that people are telling me about have not come into effect. South Korea's outcome later this year and next year does hinge on the new policies of the new president and his administration. The policies appear to be supply-side, demand-side orientation, designed to raise the potential growth of the country and allow more demand-side growth. And generally, tax cuts, deregulation, privatization, the mood of spirit of competitive enterprise, opening of borders, has produced very strong results for those countries that have attempted them. So we applaud the expected policies of the new administration. We wish the president and the country well, and we think that is a positive direction for the South Korean economy. The results could be better. But South Korea will be exposed and is exposed to trouble from the U.S. and particularly trouble from China on the export side. And that's a potential negative as we look ahead here for the next year or so. But all in all, strong growth, slight slowdown for China, diminished export growth on account of the U.S. slowdown, and a similar response for exports in Japan should slow what has been an extreme boom. The U.S. and Japan together account for nearly 30% of Chinese exports. China on exports to the top 5 export customers has about a 20% exposure in real GDP. It's not trivial. 20% of China's exports go to the United States. And so there is some danger and risk to China exports. We're expecting Chinese consumption to pick up some of the slack, but projecting that Chinese economic growth will be down to a little under 10% this year from the 11.5% or so of last year. That's still a terrific economy, that kind of slowdown. 2009, about 9% for China. This, by the way, is the first time in years that we have projected any slowdown at all for China. We have never felt there would be a boom-bust Chinese situation up to this point, and our projections have always been for China on the very high end, if not higher than the consensus, in what has been an incredible boom for that country, with spillover effects for all of Asia, that has made Asia, not just China, but India, South Korea, Singapore, Malaysia, and the growing richness of lots of Asian countries has made Asia and emerging Asia probably the most dynamic force for growth in the global economy in the last couple of years. Initially, we think back in 2003, the U.S. upturn, fueled by tax cuts, had a major positive effect on the global economy, but pretty much since that time, the story has been dynamics of Asia. For the Eurozone, somewhat slower growth this year to around 2% or so. That's also a consequence of weaker exports to the United States. We expect continuing strength in the economies of Russia, Eastern Europe, and Central Europe, Czechoslovakia, Poland, and that should support the German economy and indirectly France and Italy. There is much intra-Europe trade with a broad notion of Europe now to include what we used to call Eastern Europe and Central Europe, Northern and Southern Europe, that has made the Eurozone, we think, quite resistant to trouble in the United States. Not fully so, but quite resistant. And part it does come from the strong upward force out of emerging Europe, and that includes Russia. As long as oil prices stay up, that will be very helpful to the Russian economy. Russia has now over $400 billion in foreign exchange, close to $450 billion in foreign exchange. Russia, along with lots of other countries, is now rich. And it will be interesting to see how the various countries, many of whom are in Asia, will spend their richness, their current account surpluses that have generated huge amounts of foreign exchange reserves and spawn the sovereign wealth fund movement, where there will be much of the funds that have come from the current account surpluses reinvested around the world. Asia, Russia, the OPEC countries, the oil producers, and some commodity-producing countries, they have much of the strength now in balance sheets, international balance sheets. The U.S. does not. In emerging Asia, continuing strength in developing countries despite some slowing, over 8.5% real growth for emerging Asia, including China and India. For emerging Latin America, weakness in the Mexican economy. Mexico is very much tied to the United States because of the U.S. downturn in growth, but acceleration in the Brazilian economy, strong growth in Chile, and a still booming Argentina. In the UK, we're expecting a significantly weaker economy on declining housing and residential construction, the weakness in the financial sector, which is a big prop to London. Real economic growth should be in the 2.5% or so range in the UK. Canada, slower growth because it's tied to the United States, but basically the fundamentals are healthy for Canada. The Middle East and Israel, considerable strength and solid expansion, despite the problems in the Middle East. That's fueled by the growing largesse of Middle East oil-producing economies and a technology boom in Israel. And then for Egypt, Jordan, Kuwait, Iran, Qatar, and the Baltics, solid gains in those economies, in part from continuing high crude oil prices. That's our expectation, that crude oil prices will stay high and go higher before they go down. And that will help the whole region. In that scan, which is by and large a very positive look for 2008 at these countries, the only real downer is the U.S. So why a downbeat U.S. economic prospect and the corresponding risk to the global economy and to Asia of the U.S. situation? The U.S. recession-like prospects and its risks. How can we characterize the U.S. prospect and risk? Well, we do this by scenarios. Slowdown is one. Recession, outright recession is another. Recession-like is yet a third picture. And then we have another one, stagflation. You could throw the stagflation in with recession-like because stagflation, by its very name, means subpar growth and too high inflation, which punishes an economy from a couple of sides. We are centered on recession-like. We think we're there. And I qualitatively indicated some 8 or 10 reasons why recession-like is appropriate. One of them is GDP growth. Fourth quarter GDP growth, we're estimating at about 1%, plus or minus 0.5%. And in the first quarter, 0.5% growth. And when you get to those kinds of growth forecasts, statistical error could put you into negative territory. What's going on is the qualitative side. It's the pattern. where we expect to see continuing large declines in housing and residential construction, now presenting itself as a classic bust, in my opinion, a bust. Few people in the United States use the word bust for housing, except those who are foreclosed, those who try to reset mortgages, those who try to sell their houses in Florida, Nevada, California, and a few other places. They call it a bust. The Federal Reserve won't call it a bust. They call it a consolidation. They call it a correction. That's a very tender way of talking about something that's a classic bust. In housing in the United States, we had a huge boom. Housing prices went up incredibly. The financial system invented and produced a lot of financial instruments, which, because of low interest rates and a very accommodative Fed, coaxed all of us to try those teaser rates, adjustable rate mortgages, and to extract equity using the asset value of our housing collateral as a source. And the system accommodated that. The system invented it and led us all to the water that we Americans love to drink. It's the water that fuels our thirst for spending and for things like housing, additions and alterations, tear downs, restructuring. And that's indeed what we did. And doing that, plus the invasion of the mortgage brokers and the inducements to a lot of low-income families who otherwise couldn't buy homes, is what fed that housing boom and the tremendous rises in housing prices, which gave everyone some false security that no matter what they did, the rising value of the asset collateral would bail them out. Now the lenders, sound familiar? Have you ever been through that here in South Korea and Asia? Oh, of course you have. Oh yes, I'm sure you remember that. Well, it goes on in business cycles everywhere. We often have booms, and then we have busts. And in the booms, we often have asset price bubbles. And then those bubbles burst. And I think that's what we have in housing. Housing starts are down about 50% from previous peaks. Home sales down 35% or so. Housing prices in the various published indices showing down 5%, 6%, and at times down 8 or 9% year over year, and still going down because we still have an oversupply of residential real estate compared to demand. It's getting cheaper, but the downward movement of prices is now infecting how Americans feel about that real estate asset. It is taking down their real estate wealth in their balance sheets, and they're getting scared to belly up to buy. Plus, it's harder to get credit. Harder to get credit. Only the best creditors can now get money. And why is that? Well, that's because, in part, all of the new instruments invented using the asset value of housing collateral as ultimately the base, the CDOs, the CDXs, the mortgage-backed securities of all kinds, that were originated by a lot of mortgage brokers and financial firms, but then sold off, originate and distribute rather than originate and own, and then sold off to investors who felt safe getting a higher return on a portfolio that contained these things that paid at a higher rate. Until recently, 4 or 5 months ago, when after almost 2 years of declines in housing activity and an increasing downward momentum on housing prices, suddenly the financial institutions that own these things had to belly up and value them. And guess what? There wasn't any value. Foreclosures, bankruptcies on the rise. The value of the asset-backed securities for this wonderful, wonderful thing called residential real estate tumbling. At least 4 or 5 of our major financial institutions having to take massive, unbelievable write-downs, exits of chief executives, fraud and abuse, and the waking up now in the United States, which is what always happens, How in the world could we have let this happen? But it always happens. So our thought is, and it happens everywhere in the world, by the way, from time to time, it's part of the animal spirits of private sectors, the greed and the fear that goes on in the markets, or the get-rich-quick mentality of mortgage brokers who operated out of cards in the United States and their computer, no fees, no costs, give you a teaser rate for 2 years, no transparency on it, it goes up 3 percentage points after 2 years, and no checking of the credentials of the people who borrowed because they could never pay if those rates went up. The hope was that prices would keep going up, and they're not, they're going down. So we're not through with this yet, and that's one evolving part of the economy that's going down. Classic bust, I think. Developing weakness in consumption. Later on, we expect less business spending. That will include reduced capital spending. These days, it's very much equipment and technology, something for you here in Korea to pay attention to. Less hiring, problems in commercial real estate and in the derivative securities in commercial real estate. A rising unemployment rate, less growth in income because of that. Then less consumption spending, rising inventories relative to sales, cutbacks in production, and entrepreneurial activity, financing and business plans for expansion. All this is a recitation of a classic recession in qualitative terms. We're just not sure about the number that goes with it. We're not sure about the number at the moment. We're projecting in the ones for real GDP growth. It could, as I say, it could be negative, it could be close to 2, but we doubt that it could be more than that. So the odds on a recession-like situation, we think we're there, 100%. Technical recession, 3 chances, 4 chances of 10. That would be the classic recession. And the one question is, what will policy in the United States do in response to what's going on? The second is, how about the rest of the world? How much damage will it do? And third is, what does all of this mean for some of the financial markets? In Washington, and this is the response that I'm familiar with, I am giving some advice, doing some analysis actually for both parties, as is our nature, not to take sides, but to try to do objective evaluation of questions we are asked with regard to policies to deal with the economy. And then if there are times when I'm asked what do I think should be done, then of course I will have inputs on that to those who might ask me. On monetary policy, the Federal Reserve is going to cut rates some more. The signal from Chairman Bernanke last week was very clear. Substantive easing, that translates to probably 50 basis points cut in the federal funds rate on January 30. There might be some more injections of liquidity, but our sense is the liquidity strains in the financial system aren't as bad as they were. There were some end-of-year problems that made them that bad. But nevertheless, the auctions that the Federal Reserve has invented are continuing. They seem to be working well. The spreads have narrowed some in terms of credit within the financial system. But I must tell you, the financial institutions, the investment banking brokerage houses, the major banks, are very reluctant to lend to one another. And they are battening down the hatches. We're not through yet. We think the write-downs are still going to come on mortgages. There'll be significance. We would not be surprised to see squeezing down of the size of some of our major financial institutions. We wouldn't be surprised to see a loss of a major bank or investment banking firm, or the absorption. And we expect to see more selling of chunks of ownership in return for capital to capital for U.S. financial institutions. And as part of it, lending, borrowing will be tougher across the board for Americans, and that is pretty much the whole year. We just don't think it's going to end. We have other credit issues to go through. If the consumer weakens and the unemployment rate goes up, and consumer credit and the securities that are based on consumer assets will be under pressure. And commercial real estate, at least in the financing end of it, already is having trouble. It doesn't show up in the data yet, but the leading edge of a period of weakness in commercial real estate seems to be cooking. So monetary policy, Fed will ease. We think they'll probably take the federal funds rate down to 3.25 by the middle of the year. But as big as that is, 2 points in about 9 months, we just think it's too little and too late. That interest rates alone and even the injection of liquidity can't turn the momentum around. It can kind of cushion it a little bit and set the stage for the next upturn, which would be sometime in 2009 in the interest rate sensitive areas, the main one being housing. On the fiscal side, it is looking like we will have some fiscal stimulus, about $100 billion worth. Frankly, that's almost nothing in an economy that's almost $1.5 trillion in size. And so the timing of it, the amount of it, the nature of the fiscal stimulus, tax rebates, temporary tax cuts, transfer payments like on unemployment insurance, some increase in government spending, the multipliers aren't all that strong. It's not that big to begin with. So it can help temporarily, but it's not going to fundamentally turn it around. That's our view of the Washington response. It is evolving. It could change. I'm actually a participant in some of those conversations, but I don't suggest $300 billion of stimulus, fiscal stimulus, because my fear is Washington will do it in the wrong way, and then we'll have long-run consequences. So I'm simply making a few comments and evaluating the programs that Republicans and Democrats are thinking about. We're running through our model, and they're thinking about a lot of things, but there is a consolidation toward $100 billion or so of fiscal stimulus. The combination of fiscal stimulus of that size and the rate cuts probably will set the stage for a better U.S. picture by the second half of 2009. It could be sooner. Nobody really knows about the private sector, but our sense is there are more negatives yet to come in the private sector that will overwhelm any of the positives that come out of the fiscal stimulus. As far as the rest of the world, there's no doubt, at least from our research, that there is increased decoupling of Asia from the United States that has been occurring over the last 10 or 15 years. You see it in the trade data. You see it in the increased intra-regional trade and influence of China on the Asian and Pacific Rim countries. Now, compared to 5 years ago, 10 years ago, 15 years ago, it's quite striking. You see it in the financing that goes on and the ability to finance within Asia by Asian companies turning to Asian financial institutions, not necessarily having to go elsewhere. And of course, policies are decoupled. Japan can run its own economic policy. China can run its own economic policy. South Korea can undertake market-friendly activities and tax cuts. That's not so easy in the Eurozone to do all that. And of course, every country has its own monetary policy here in Asia. And no country out here has to do it the way the U.S. does it. No country has to do it the way the U.S. does it. And Asia is in very good shape on current accounts and on foreign exchange reserves and surpluses. Frankly, rich, relatively speaking. That says to us that there will be a lot of resilience to whatever downturn goes on for all of those reasons. Nevertheless, there is still exposure, and it is non-trivial, and it is a flag. China, for example, as I mentioned, 20% of its exports go to the United States. China's economy, depending on the numbers you look at, could be 40% open. That's 8% exposure on GDP to the United States. China sells more to the United States than ever before. Japan is the second largest buyer of Chinese exports. And of course, Japan's exports, still much less compared to what they used to be to the United States, nevertheless still exist. So if the U.S. goes down, by whatever the U.S. goes down, Japanese exports will have some damage, and then Japanese purchases from China will have some damage, and China will have some damage from U.S. purchases from China. And South Korea, whose economy now is so much more open in terms of the percent of exports to GDP than it was 10 or 15 years ago, though its trade is much greater intra-regional which protects it from a U.S. downturn, unless China goes down, is now so much more open that the exposure on GDP from its five major export partners, South Korea, is over 30% on our calculations. That is to say, to China, between the percentage of between the percentage of South Korean exports that go to China and the 61%, that's our figure, it could be higher, openness on exports that we have in the data we've looked at, that's a 15% exposure to China on real GDP. The U.S. is a little over 8% exposure. Well, the Chinese exposure on GDP in 1995, that's just 12 years ago, was about 1.5%. It's almost 15 times now. On exports, in GDP terms, you're about 15 times more exposed to China. So let's hope China, for South Korea's sake, does well. But that's quite a change. And of course, it's good, probably good for South Korea to be more tied intra-Asia, because Asia is the strongest growing region in the world. But the bad is if anything happens to China, or Hong Kong, or Japan, South Korea's exports will suffer. The U.S., of course, as well. The exposure to the U.S. is about double what it was in 1995. Not because of the percentage of exports that South Korea ships to the United States compared with 10 or 15 years ago, but because the South Korean economy has gotten so much more open. It's part of the great success over time of the South Korean economy. So the message on decoupling is, yes, decoupling definitely has occurred. Around the world, you see intra-regional trade flows that are very much contained. North America's contained, the Eurozone's contained, Asia's contained. But there will be damage nonetheless. The world cannot escape from a U.S. downturn of whatever size. And of course, the bigger the downturn, the greater the damage. And all of you in business or in government or in the markets need to be aware of that and not get too complacent about potential damage coming from the U.S. downturn. Well, as far as damage goes, it brings me to a few concluding remarks about financial markets. In the U.S., of course, with this outlook, I think it's no surprise to you to hear me say that our view is that the U.S. equity market is in a bear market. It probably started sometime in the second half of last year. These things tend to last about a year. Classic response is lower interest rates. The private sector goes through all of its trouble, and later on, you start the next bull market. We don't think this one's going to be a V, nor do we think the downturn in the U.S. in growth or otherwise will be a V. We think it'll be more of a kind of a bowl-shaped type of thing. But we're not calling bear equity markets anywhere else in the world now, except there is some risk. The U.S. situation is very much homegrown, and we will have to wait to see how much of the U.S. downturn spills over, spreads, how much contagion there is before we would go out on a limb on something like Asian stock markets, where we remain bullish, strategically bullish. We continue to advise our clients to be overweight in Asian equity markets. South Korea is absolutely an overweight for this next year on our scheme of things. China remains a cautious overweight. We're a little concerned about the export risk. China's raising interest rates, the currency's going up. A lot of things are happening that could slow it down. And, you know, even a modest slowdown in China, even if it were not significant economically, could take a stock market with a very high P/E ratio and send it south. And so we're a little more cautious. But generally, we think, other than the initial perception of U.S. trouble bringing down stock markets everywhere, which is the way we've started the year, that when the dust settles, we do think the performance will reside once again with the Asian stock markets. And I think it's clear that for the dollar, our perception remains a weaker dollar, U.S. dollar against major currencies. This year, once again, we think the dollar will be weak against the Asian currencies. This may be the weakest area. We are thinking the Chinese I'm going to let that currency go up 10 to 15%. It went up 7% last year. Other currencies may move in sympathy with that out here in Asia. We are targeting and expecting the euro to rise against the dollar 160. Last year, I think we were 145. It's pretty much where we ended up the year. The dollar yen, with the trouble with the Japanese economy and low interest rates, we think the yen will rise to something in the low 100s by the second half of the year. The dollar downtrend, on average, we don't think is over. And I'm not quite sure when that downtrend ends. At the moment, the longer run picture for the U.S. is not something that I personally am feeling very good about. Let's wait and see how the political season ends, who gets elected, what the policies are. The assumption we're making is a Democratic president, a Democratic Congress, major changes in economic policies, a reevaluation of trade. There is protectionism in the United States. We are expecting taxes to be raised if the Democrats win on the higher income families. And we're expecting major programs, health care, spending programs to be installed if it is a Democratic Congress and a Democratic president. I do not know, nor do I have an opinion on whether it's Mrs. Clinton or Obama. I will tell you, though, in the United States, the sentiment is very interesting. Obama is caught the fancy of a lot of Americans, Democrats, who were previously fans of Mrs. Clinton. It's clear he doesn't have the experience internationally and domestically, but he's inspirational as a young, very bright man, and his oratory is kind of from another planet. It's so good. Mrs. Clinton appears to have a better set of qualifications, but there's something about the Clintons that seem to be bothering Americans. And so it's really a toss-up at this point. On the Republican side, that's another tough one. My guess is Senator McCain will be the nominee, if only because he's one of the few candidates that a lot of Americans, Democrats or Republicans, look at and say, no matter what he thinks, we know what he thinks. He's a man of reasonable integrity, relatively speaking, compared to the other politicians. And I think this is a year where Americans want to get the straight scoop, and where Americans are very much in the mood for change. Being in the mood for change is not always a good thing. I think after 25 years of market policies, laissez-faire, less regulation, I think the U.S. is going to go in the opposite direction to the direction Korea is going in. So if you're a competitive sort, I think I'm going to bet on Korea and not on the U.S. My money is going into the Korean stock market, not into the U.S. stock market. Thanks very much.